Happy New Year, everyone. We hope you had an amazing holiday season with your loved ones. I'm Michael Henley, the CEO and founder of Brandywine Private Wealth. I'm joined by Peter Kim, our Chief Investment Officer. And today we're here to talk about reflecting on 2024, as well as kind of what took place in the fourth quarter. So we will jump right in. Peter, 2024 was an amazing year in the markets, with the S&P up 20% again in 2024 after up more than 20% in 2023. Do we expect this to continue in 2025?
It'd be nice if everything just went up all the time. That'd make life really easy. But in reality, life and volatility does kind of come into play. So it'll be interesting to see if we can continue to see this growth dominance in the US going into 2025. I suspect that we'll probably see a little more normal volatility. So expect some ups and downs, some peaks and valleys in the market throughout the rest of the year, or throughout, I guess, all of 2025 at this point. 20+% returns again, probably unlikely just because we're starting at such a high level to grow from. It'd be tough to say that we're going to see that kind of continuing carry on.
I think the consensus on Wall Street for 2024 was up 5%. We came in up 25% or something. You think Wall Street will be kind of wrong again in 2025?
Wall Street's very optimistic all of a sudden, playing a little bit of catch up.
Yep.
They're projecting minimum basically around plus 10% returns from the US. Certainly not really unfeasible and possible, but again, not necessarily probable given kind of historically what the market has done.
Okay, got it. Biggest surprises in 2024. Once again, for whatever it's worth, Bitcoin was the best performing asset class last year, up 120% or something.
Mm-hmm.
Gold seemed to outperform stocks last year. Is that
gold being up almost 25% is pretty impressive. It's a very interesting inflationary hedge with inflation coming down as aggressively as it did and still having that inflation head or threat, I guess, of inflation kind of creeping back up, propelled gold a little bit higher. So that was a very interesting windfall for everyone that had it.
Yeah, definitely the biggest surprise, I think. Are we seeing this only in the US, Peter, or is it globally as well?
Yep. Globally, the US markets are definitely a little bit tougher. I would say the US has been the shining star for a while at this point. Europe certainly has its own issues. China definitely has some issues, not in love with any of those areas in particular, outside of kind of pocketed specific countries. But in reality, if the US's starting point is up here, international market starting point is down here. And I think realistically, when you kind of look at how the market is being priced in right now, it basically worst case scenario is being priced in for Europe and China.
Okay.
And best case scenario is being priced in for the US markets. I could easily see it being somewhere in between those two. And the European markets, emerging markets, surprised to the upside just because their expectations are so low at this point.
Okay, got it. Because the US, while it's outperformed, is extraordinarily expensive relative to history, right?
Exactly. Valuations are really, really high. So you're starting at a very, very high point. It certainly can continue, but it's just tougher to see that kind of continual gain.
Got it. Yeah, we like to say we can't predict the future, of course. But we like to say that bad things tend to happen to expensive markets, right? We never know in advance what the catalyst will be, but typically when markets get overvalued, something kind of will happen, right?
Exactly.
What's the latest news, Peter, from the Federal Reserve? What can we expect there on interest rates?
Sure. So they cut rates again in December, which is good to see. They're kind of forecasting that would happen. So glad to see they followed through with that. We're now at about 4.25 to 4.5 for federal funds interest rates. I think with the new administration coming in, everyone is kind of in pause mode at this point, including the Federal Reserve.
Okay.
They're waiting to see what the new administration is going to do, how inflationary are their actions going to be on day one. Does that impact the economy in a real negative way where they need to continue to cut rates? Or is inflation going to continue to increase and they need to kind of hold off? So I think they're very much in wait and see mode with basically everyone else now.
Got it. As it relates to the new administration, are there certain sectors or parts of the market that may do better or worse given the backdrop?
Sure. Growth has really outperformed. I think large cap tech, they have very lofty expectations going forward. I wouldn't be shocked to see them kind of come back down to reality. I think when you look at the other side of the balance sheet though, or the other side of the market, the value side has really been lagging. Theoretically, deregulation should be much more pro-business, much more M&A activity. Financials are typically areas that do very well there. Small caps and smaller companies can also be very good in a kind of deregulatory environment. So there you should see the value side of the trade kind of start to show some more increase there.
Okay, got it. Peter, how about our portfolio models? Any recent changes there?
Sure. Portfolio models for us, we've continued to let them drift. So as the stock market has grown for us, especially in the US, that has allowed the market, their portfolio models to kind of drift with it. So we've been slowly expanding our stock market exposure there. and just letting that underlying exposure kind of rebalance underneath it. But by and large, we're letting the market kind of drive that force at this point. So no major changes, no tactical adjustments, letting the market kind of grow and expand, and the portfolios do that as well.
Got it. All right. As always, we'd like to talk about the 8 indisputable laws of investing. Today, we're going to cover law number 6, that many investing failures can be traced to the pursuit of arbitrary benchmarks. Peter, can you elaborate on what that means?
Absolutely. So it's typically people assigning a random benchmark, say the S&P 500 or the Dow Jones Industrial Average, say, I want to compare myself to that. Be it good or bad, that's how I determine if it's a good year or a bad year.
Yep.
In reality, benchmarks are kind of arbitrary, as you mentioned, and you really want to focus on what is a comparable benchmark to the amount of risk you're actually taking. And more importantly, how does that benchmark compare to the planning that's being done? The planning that's being done from a financial firm like ours is always built around some sort of return assumption.
Yep.
And as long as the planning that you're doing is matching the investment returns, that's the most important key to success. Not necessarily trying to time the market, generate absolute returns, and take on a ton of risk. If your plan doesn't need that amount of risk, don't increase that variable and bring in these unknowns where you can kind of harm yourself.
Got it. Okay, that makes a lot of sense. So I guess risk-adjusted returns is what matters. So if you outperform the market, if you took on twice the amount of risk, you didn't really win there, right?
Exactly. Yes, you performed well, but from an absolute basis, it's not really a great return based on the amount of risk you're taking.
Got it. Thanks everyone for watching. If you have any specific questions, reach out to your Brandywine relationship manager. We're looking forward to another amazing year in 2025.